Gold reserves remain a critical component of national financial systems, even in our digital age. Despite the rise of cryptocurrencies, gold's unique status persists. But what makes gold reserves so crucial? Let's delve into the reasons. Number 1, cornerstone of economic stability and national prestige. Gold serves as more than just a precious metal. It's a key indicator of economic stability and national wealth. Countries maintain gold reserves to safeguard their currency value, boost their global standing, and maintain economic balance. Consider the United States and Switzerland. The U.S., as a global financial leader, keeps substantial gold reserves. This protects the dollar's value as the world's main reserve currency and reinforces America's economic power. It also acts as a financial safety net during crises. While the US dollar was once tied to gold under the gold standard, this changed in the 1970s. Today, the dollar's global dominance stems from the US's economic strength and stable financial system, not its gold backing. Switzerland, known as the world's gold haven, plays a crucial role in the global gold market. Its long history in gold mining and processing, coupled with its neutral political stance, has made it a prime location for gold storage. This attracts international investors and financial institutions. Swiss banks are famous for their strict confidentiality, ensuring top-notch security for stored gold. This has cemented Switzerland's reputation in the global gold market, making it a top choice for investors and central banks alike. Switzerland is a major player in global gold trading and a significant gold producer. Many international financial bodies store their gold in Switzerland, further solidifying its position in this field. The country's high-quality gold products also contribute to its strong market presence. Number 2. Gold as the ultimate financial safeguard. Gold serves as a stable, highly liquid, and widely accepted financial instrument, acting as a crucial final payment method and economic safeguard. The Great Depression and 2008 financial crisis highlighted gold's importance during economic turmoil. In the 1930s, countries abandoning the gold standard led to monetary system distrust and rising gold prices. Gold became more trusted than paper money, with people exchanging currency for gold. As inflation rose due to increased money printing, gold's scarcity made it an effective inflation hedge. During the 2008 crisis, gold reaffirmed its safe haven status despite no longer being official currency. Bank and stock market collapses drove investors to gold for security. It also proved valuable for portfolio diversification, reducing risk as other assets declined. Comparing these crises reveals similarities and differences. Both events severely undermined confidence in existing monetary systems, prompting investors to seek gold's safety. In both periods, gold effectively protected asset values against economic instability and inflation. Key differences exist between these crises. The Great Depression occurred under the gold standard, while the 2008 crisis happened in a post-gold standard economy. This shift changed gold's economic role. During the Great Depression, gold was central to economic stabilization. In 2008, it primarily served as a value preservation tool for investors. Gold's scarcity and historical significance have consistently proven its worth as a final payment method and safe haven asset during economic instability. However, its economic role has evolved. Once central to the international monetary system, gold now primarily functions as an investment tool and portfolio diversification element. Number 3. Economic stability through gold reserves. Gold, a hedge against inflation. Zimbabwe's economic crisis in the 2000s clearly shows how gold protects against inflation. Bad policies led to extreme price increases, making Zimbabwe's currency worthless. People turned to gold to save their money. They bought gold bars, jewelry, and raw gold. Gold helped in 3 ways. It kept its value while Zimbabwe's dollar crashed, it became a way to buy things, and it protected some of people's savings from inflation. This case proves why gold is valuable when economies struggle, especially with high inflation. It also shows the problems with paper money, not backed by anything solid. Since there's only so much gold available and it's not easily influenced by politics or the economy, it's safer to have when things are uncertain. Gold, a means to overcome economic recession. When economies slow down, people want more gold. This helps countries get money to boost their economies. Gold is like a safe place to keep money when the economy is bad. When stocks and money lose value, people buy gold to protect their savings. Here are some examples of how gold helps during tough economic times. Gold consistently serves as a financial safeguard during economic downturns. Both private investors and governments rely on gold to maintain asset value. This is because economic crises typically cause global market instability. As a result, gold prices often spike, showing its high demand as a reliable way to preserve wealth. Economic crises affect gold's role differently. In the Great Depression, stock market and banking collapses drove gold buying. The 1973 oil crisis caused high inflation, making gold valuable against currency devaluation. The 2008 financial crisis started in real estate and spread globally. The COVID-19 pandemic disrupted economies worldwide. Despite their differences, each crisis showed gold's importance as a safe asset. Number 4. Diversifying investment portfolio. Gold serves as a crucial tool for diversifying investment portfolios. By including gold alongside other assets like stocks and bonds, nations can effectively spread their risk. Here's a straightforward example to show why diversification matters. Consider two scenarios. In the first, you put all your money, 100 million dong, into stocks and bonds in 2023. When a global crisis hits in 2024, stocks crash by 30% and bonds barely make any money. Your investment shrinks to 70 million dong. Now consider a diversified scenario where you split 100 million dong equally between stocks, bonds, and gold in 2023. When the crisis hits in 2024, stocks still fall 30% and bonds perform poorly, but gold prices rise by 10%. This diversification helps cushion the blow, resulting in a portfolio value of about 80 million dong. Diversifying with gold makes a clear difference. In our example, the stock investment dropped to 23.3 million dong, bonds stayed flat, but gold rose to 36.6 million dong. This mix resulted in a total portfolio value of 80 million dong, a smaller loss than investing in just stocks and bonds. The numbers speak for themselves. A stocks and bonds only portfolio lost 30% of its value. By adding gold, even with declining stocks, the overall loss was cut to just 20%. Gold's performance helped cushion the blow from the stock market downturn. Portfolio diversification works for two key reasons. When stocks fall, investors buy safer assets like gold, pushing gold prices up. Also, spreading money across different investments reduces losses if one investment performs poorly. Keep in mind that all investments carry some risk. Even gold, often seen as safe, can lose value. How you split your money between different investments depends on your goals, how much risk you can handle, and what's happening in the market. Number 5. Leveraging gold in international relations. Gold reserves serve as a powerful tool in international negotiations and trade agreements. Countries use their gold holdings to strengthen their bargaining position and secure favorable terms. The Bretton Woods system and the Cold War era both showcased gold's significance in global relations, but with distinct approaches. During both periods, gold functioned as a universal value measure, a stable standard for international transactions, and a key component of national foreign exchange reserves. Countries leveraged their gold reserves to project economic strength and gain political influence. The Bretton Woods system linked currencies to gold through the US dollar, aiming to stabilize global finance and boost post-war recovery. However, limited gold supplies eventually led to imbalances, and the system's collapse in 1971. In contrast, the Cold War saw superpowers using gold reserves to fund arms races and sway developing nations. Gold-based aid became a means to secure political allegiances, with large gold holdings symbolizing a nation's economic might. In summary, gold reserves play a crucial role in ensuring the economic and financial stability of a country. They are a symbol of wealth, a means of last resort payment, a tool for diversifying investment portfolios, and an effective diplomatic instrument.